Dividends will destroy your investment returns. Today I will show you how and what to do to avoid it. Hello fellow human, nobody here. In this video I will dismantle the myths surrounding the concept of the dividend, which is so often overhyped and portrayed as something it is not. I hope you enjoy the video. It is a bit long and it is a bit dense, but I structured it into chapters and did my best to make it as clear as possible. If it brings you any value, please like it and subscribe to the channel to be notified of future content. It helps immensely. Before we get started, a quick disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only offer you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. First, some psychology basics. As social animals, when we lack confidence in our knowledge, we find comfort in making the choices that we believe are going to attract the least amount of criticism if things go wrong. And then, as the saying goes, slow and steady wins the race. However, it is not the lack of speed, but the power of consistency that brings us success. It's not that being slow is positive in any way, at least not in most circumstances. It's that consistency is so important that we should not sacrifice it for speed. But do most people realize this? The idea that being slow and playing it safe go hand in hand is such a common misconception that it becomes a kind of popular wisdom. And when people are not sure about their choices, they stick with popular wisdom. You're not going to be criticized much for following what most people believe. You might think dividends are the safest way to secure a financially sound future. After all, making money from dividends is very slow. But what is safety, really? Is it being able to sell your shares for a good price at any given time? Or perhaps being able to accumulate sufficient wealth to be financially independent? Let's take it one step at a time. A dividend is a payment made by a company to its shareholders, usually in the form of cash. Generally, dividends are paid out of the company's earnings, but they can be supplemented from the cash reserves if profits have been insufficient recently and the company wants to keep paying the dividend. Using the cash reserves to pay the dividend is not necessarily a red flag. In fact, the whole point of reserves is to have a safety net for the times when the bottom line of the company takes a hit. So, unless the company is reducing its cash reserves year after year just to keep paying the dividend, it should be okay. If the company can afford it, does it always make sense to pay a dividend? It depends on which opportunities for growth the company has. Dividends are money that the company is not reinvesting into its own operations to grow. And the less the company grows, the less the earnings will grow in the long run. And lower earnings mean a lower ceiling for the share price and the dividend. Saying it like this, receiving a dividend might seem like getting one cookie now instead of 2 cookies tomorrow. But it's not so straightforward. And reinvesting all excess cash into the business is not always the right thing to do. The truth is that not all companies have good growth opportunities all the time. Companies may face limited growth opportunities due to market saturation, industry constraints, economic conditions, or any number of internal factors. In these scenarios, pouring money into new company projects might very well yield low or even negative returns. For example, imagine a supermarket chain building new stores in areas of low traffic because the company already has stores in all the good spots. It would be a terrible thing to do if these new stores earn less money than they cost to build and operate. In such a case, it is preferable to give investors that money instead of risking it, opening new stores of predictably low profitability. On the other hand, if the company has profitable ways to keep expanding its operations, it should invest in them. Let's now see what kind of stocks we can find based on the dividend policies of their companies. The classification is really simple. If the company distributes some of its earnings to shareholders in the form of a dividend, we have a dividend stock. And if the company doesn't pay a dividend because it completely retains and reinvests its earnings, we have a non-dividend stock. This is the black and white theory. But in practice, the label dividend stock is used to refer to those stocks whose dividend is high enough to be a key reason for buying the stock. Generally, dividend stocks should have a dividend yield of at least 2%. And if the dividend yield is higher than 4%, then we're talking about high-yield dividend stocks. From now on, when I say dividend stock, I will be referring to those stocks with a dividend yield of at least 2%. In the camp of stocks that pay little to no dividend, we find the bitter rivals of the dividend stocks, the growth stocks. In theory, there are also stocks that both pay little to no dividend and have low growth. In practice, I pretend they do not exist, and so should you. Growth stocks belong to companies focused on reinvesting their earnings back into their operations for further revenue and earnings growth. They can also pay a dividend, but it is generally very small. For this reason, with growth stocks, the vast majority of the total return comes from capital appreciation and only a small fraction comes from dividends. Of course, when I say capital appreciation, I'm talking about the gains that come from the share price going up. With dividend stocks, on the other hand, the weight of the dividend on the total return can vary a lot, but on average it is around 1/3. For example, a dividend stock may have a dividend yield of 3% and a share price that goes up by 6% per year, for a total annual return of 9%. 1/3 dividend, 2/3 capital appreciation. Growth stocks may pay a dividend even if it is very small for several reasons, such as to attract investors that are only interested or even allowed to invest in companies that pay a dividend. Another reason is to start a track record. Decades from now, what will matter is for how many years they have paid and increased the dividend. And no one will think twice about the many years that the dividend was tiny. Companies that have been paying and increasing their dividend for more than 25 years without interruption are called dividend champions or aristocrats. And those that have done so for more than 50 years are called dividend kings. The ability to keep paying and increasing a dividend over long periods of time is greatly appreciated by investors, and rightfully so, because it shows that the company has been reliably profitable for many years. And most importantly, a company paying dividends for decades suggests that the management has been capable, stable, and financially disciplined in good times and bad. That the company is managed so responsibly that it has been able to hand out increasing amounts of money to investors even in the hard times that the company, the sector, the industry, or the whole world have faced through the years. This sounds pretty amazing. What's the catch? As we will see, there are some very clear advantages and disadvantages to both dividend and growth stocks. But before we talk about that, we need to set one thing straight. Money is money. Some people compartmentalize money based on imagined qualities, such as whether it comes from dividends or from selling shares. I get that you might want to draw a distinction between the money made working 3 jobs for 20 years and the money made from selling drugs. But money from dividends and money from selling shares are exactly the same and equally legitimate. Some people might feel dividends are more tangible than capital appreciation because you get the dividends automatically into your bank account and you can spend the money straight away. But, spoiler alert, you can do the same thing selling shares at any time. And in fact, with dividends, you will arguably be more tempted to spend the money if it goes passively into your bank account. But wait, if you sell shares, you're losing something important, right? Absolutely not. The number of shares is meaningless. Unless you're a big investor who wants to maintain a certain voting power within the company, what matters is the total value, the capital that you have invested. And if the value goes up 10% and you sell 5%, how is your invested capital going down? Going back to the idea of dividends being more tangible, you might be surprised to hear that the share price of growth stocks is in fact not moved by fairies or even speculation, at least not in the long term. The share price actually follows the company's earnings, the same kind of very real earnings that dividends come from. When comparing stocks, what matters the most is the total return, which is the combination of the capital appreciation and the dividends received from owning the stock. With that said, aside from the misconceptions I've mentioned, there are some very real differences between dividend and growth stocks that need to be taken into account. As with most things in life, each type of stock has strengths and weaknesses. And as with most things in life, the right choice for you will come down to time and money. Ask yourself this: am I short on time? Do I need income from my investments right now or in the near future? If so, dividend stocks might be the way to go. In the short term, dividends are more predictable than share price increases. With dividend stocks, you periodically receive a relatively reliable amount of cash. With other stocks, if you need extra cash, you need to sell shares. If you rely on selling shares for income, you may very well find yourself needing to sell shares when the market is going down or maybe even crashing. And that is terrible because you are then selling your shares at a discount and maybe even for less than you paid for them. The good news is that you can avoid needing to sell shares at the wrong time by having enough cash reserves at all times. As long as you have enough cash on hand to cover any expenses for the duration of a worst-case bear market, you will not need to sell any shares while the prices are down. The bad news is that in a worst-case bear market, adjusting for inflation, it can take the stock market more than a decade to recover its pre-crash value, which is what happened after the crashes of 1973 and 2000. Sure, the 2000 crash had to happen because there was a huge bubble, but stocks were unfairly punished for many years afterward, especially with the 2008 crisis. In the case of the 1973 crash, people said for many years afterward that the Nifty 50 had it coming because they were massively overvalued. But 25 years later, it was pretty clear from the long-term performance of the stocks that even at their 1972 peak, they were actually reasonably valued, and that they had stayed deeply undervalued for many years after the crash. Turns out, PE ratios can be very high if earnings growth is strong. Who knew? So, what I want to say here is that even if you pay the right price for the right companies, weakness in the economy and pessimism in the market can take your shares for a prolonged, irrational nosedive. In such a scenario, you obviously do not want to rely on selling shares for income. The share price of dividend stocks also suffers during extreme bear markets, but it does so to a lesser extent than growth stocks. And most importantly, most dividend champions manage to keep paying and raising their dividend. Most, but not all. So you need to assume that during hard times, at least some of your dividend stocks will reduce or even stop paying a dividend temporarily. All in all, dividends sure seem the way to go in such an unpredictable and sometimes scary world. However, ask yourself, am I short on money? Is my current capital insufficient to yield dividends that can cover my expenses? If so, growth stocks are most definitely the way to go. Because if your expenses are, for example, $4,000 per month, even with a generous 5% dividend yield, you would need to invest almost $1 million to cover those expenses with the dividends. Of course, each person lives in a different country with a different cost of living and a different lifestyle, so it is up to you to do the math. If you do not have enough capital, regardless of your age, you are necessarily in the accumulation phase. You are at a point in your life when you must grow your savings. You don't really have a choice, unless starvation is a choice for you. As I explained earlier, with dividend stocks, you are investing in companies with limited growth opportunities, which is why they distribute some of their profits as dividends. With growth stocks, little or no dividend is paid because there are better things to do with the profits. Growth stocks receive their name from the fact that their companies do have good opportunities to grow. The fact that they grow faster translates into a share price that goes up more quickly than that of dividend stocks. In the early stages, growth stocks usually only grow their revenue, but they are expected to eventually grow their earnings as well. And when they do grow earnings, they grow them very fast. And investors value these stocks based on this expectation. Because remember, the share price follows earnings. Expected future earnings, to be precise. So let's talk numbers. Major US stock market indexes have returned on average between 9 and 14% per year over the past 40 years. The S&P 500 and the Dow Jones have been on the low end with a 9% return, while the Nasdaq Composite returned 11% per year, the Nasdaq 100 returned 14% per year. This is not surprising given that Nasdaq companies grow faster. These differences of 2 or 3% between indexes might seem small, but they result in massively different returns over long periods of time. Take a look at this. 9% over 20 years increases your investment 5.6-fold. Not bad. 11% increases it 8.1-fold. And 14% increases the same investment 13.7-fold. That means with an annual return of 14%, you would end up with 2.5 times more money than with an annual return of 9%. I don't know about you, but $10,000 and $25,000 are not the same to me. I'm not talking about maximizing your wealth to infinity for the sake of it. I'm talking about reaching a critical mass of capital that will give you financial independence and allow you the choice to live off your investments. If you start with an already large amount of money, good for you. You can afford mediocre returns if doing your best is not your thing. However, most people do not start with much money, and maximizing returns is a must. In case you're wondering how much capital you should be aiming for, as a rule of thumb, the money you need to live off dividends is 400 times your monthly expenses. To bring home the importance of maximizing returns, let's now take a look at the performance of different rates of return over time. For this scenario, I'm going to keep it simple. It assumes you add $6,000 to your investment each year, equivalent to $500 per month. You do this 20 times, first in year 0 and last in year 19, for a total invested principal of $120,000. This table shows how the investment grows over time for each return rate between 5% and 20%. At the bottom of the table, you can see how each return compares against the 5% return at year 20. You can see the numbers diverge faster and faster over time, and by year 20, the 20% return has 6.5 times as much capital as the 5% return, and almost twice as much capital as the 15% return. And yet, this table gives us a distorted comparison because all the rates of return include the same base amount that comes from the money that has been added over the years. So the actual return on investment is partially hidden. Now look at this. This table shows only the investment return instead of the entire accumulated capital. It excludes all the contributions made over the years, so we see only the money that has been generated, the actual profit. And the difference is massive, because of course, those $120,000 contributed throughout the 20 years have a much larger weight on the smaller amounts of total capital. At year 20, the 20% return has generated 13.9 times as much profit as the 5% return, and not 6.5 times as the first table suggests. But wait, there's more. Did you forget about inflation? Here I am adding a 2% inflation rate. It is extremely important that you keep inflation in mind when estimating the capital you will need to live off that capital, be it through dividends or some other kind of income-oriented investment. For example, with an inflation rate of 2%, $4,000 today have the same value as $6,000 in 20 years. So the amount you will need in 20 years just became 50% bigger. As a result, if you estimated that for your time horizon you need an average return of 10% per year, make that at least 12% to compensate for inflation. Now let's take a look at the investment returns with and without inflation. As you can see, inflation makes the difference in performance between the different return rates even more clear. After 20 years, the top rate is giving us 19.4 times as much return as the bottom rate, up from 13.9 times seen on the table without inflation on the left. This is because inflation is subtracted equally from all rates of return and so has a bigger relative impact on the lower ones. With a 2% inflation rate, a 5% return rate becomes 3%, and a 20% becomes 18%. In fact, in our example here, adding the 2% inflation reduced the return at year 20 by 29% for the top rate and 49% for the bottom rate. You should take inflation into account when comparing the past performances of different stocks and ETFs. For reference, in the past 40 years, the accumulated US inflation has been 203%, on average 2.8% per year. If you omit inflation, you will be underestimating the relative outperformance of the best stocks and ETFs. Inflation aside, I hope this little exercise illustrated clearly the importance of maximizing returns and not settling for what you've been told is the normal market performance, which is usually around 8 to 10%. Considering the historical performance of the Nasdaq Composite and the Nasdaq 100, your benchmark during the accumulation phase should be at least 15%. And the way to match and ideally outperform this benchmark is with growth stocks, because their superior earnings growth is what makes their share prices move up much more quickly. and no dividend payments can ever compensate for this. Unless we're comparing overvalued growth stocks with undervalued dividend stocks, growth stocks will have significantly higher total returns than dividend stocks. You may have abnormal periods of a few years when this doesn't happen, especially when the market panics and stocks become oversold. But in the long run, it is not a serious question. Growth outperforms everything else. You might be wondering, what should we do with the extra volatility that comes with growth stocks? Nothing. In the accumulation phase, you add money to your investments and you rarely sell. And if you do not need to sell shares, it does not matter how much your stocks fluctuate. Now I need to address one little thing that dividend proponents seem to get overly excited about. With dividend stocks, when the share price goes up, the dividend yield goes down simply because it is the dividend payment divided by the share price. This can be a problem because something positive like the share price going up is making the dividend yield look bad, which is absurd. And overall, the dividend yield is not very useful to compare different dividends and their return over time. The yield on cost solves these issues by using the original share price as the constant denominator. This way, regardless of the share price movements, the yield on cost reflects the dividend you get relative to what you actually paid for the shares. Let's see an example. Here we have a dividend stock that we bought for $100 per share, and whose dividend yield was 3% at the time of the purchase. We assume that the share price increases by 10% per year in all cases. On the table, we have dividend growth rates of 5%, 10%, and 15% per year. We see the dividend payments per share that we would receive every year, which of course is not affected by the share price. Now let's compare it with the dividend yield, which is the dividend payment divided by the share price. As you can see on this second table, the dividend yield decreases when the share price grows more than the dividend, and vice versa. When both the share price and the dividend grow at the same 10% per year, the dividend yield stays the same. But of course, if the share price goes up a lot and it looks like the dividend yield has become low, that doesn't bother us. What matters to us is what we paid for the shares and the dividend amount that we are receiving. And of course, shares going up is 100% a positive thing. The dividend yield is relevant for those who are buying the shares today, because it tells them how much dividend they are getting relative to what they are paying for the shares right now. To properly see how much you will be getting from the dividends over time, you need to look at the yield on cost. On this third table, we have the yield on cost, which we obtain by dividing the dividend payment by the share price at the time of our purchase, and we ignore the share price growth. Naturally, the yield on cost always grows as long as the dividend payments keep increasing. Looks pretty impressive, doesn't it? After several decades, you might receive dividends larger than the price you bought the shares for. So far, so good. The problem is that some people get overly excited about it. Yes, you're getting pretty large numbers as time goes by, but do not get carried away. The same can be done for capital appreciation. Here we have a stock that does not pay a dividend, and so we rely entirely on the share price going up. On the left, we have the yield on cost table from before for comparison. On the table in the middle, you can see the share price growing 5, 10, and 15%. And on the right, we have the equivalent of the yield on cost for the share price growth on cost. You can see the same kind of exponential growth as with the yield on cost. With a 10% share price growth, the share price goes from $612 in year 19 to $673 in year 20, which is an increase of $61. So 61% over our initial share price of $100. This might seem a bit absurd for capital appreciation, but I think it is very important that we make sure we don't get any illusions about what kind of return we can get from dividends. And especially so that we are not fooled into thinking that dividend stocks can outperform growth stocks in the long run. With that said, yield on cost absolutely should be used when comparing different dividend stocks, because it reflects not just today's dividend payments, but how much they will grow if you hold the shares for many years. So my point here is that you should compare dividends and capital appreciation honestly and on equal grounds. With that out of the way, let's now do a quick recap of the whole thing. bottom line is that dividends are a terrible thing to pay attention to when you still do not have enough capital to live off your investments. To be sure, it's not that dividends are harmful in any way or that you should actively avoid them. It's that during the accumulation phase, when you're building up your capital, you need to focus on total returns. And total returns are higher for growth stocks, which pay little to no dividend, because for these companies, reinvesting their cash into themselves is highly profitable. At the same time, once a 3% yield on your accumulated capital can cover all your expenses, you can begin to consider shifting to a dividend portfolio. As a rule of thumb, the capital you need to live off dividends is 400 times your monthly expenses. One option is to allocate to the dividend side as much as needed for the dividends to cover your expenses and keep the remainder on the growth side. You can also stick with an entirely growth portfolio indefinitely. But if selling shares is your main source of income, you should have enough cash reserves on hand to cover your expenses for an extended period of depressed share prices. You do not want to sell shares when the market is undervaluing your stocks, which A, tends to happen unexpectedly, and B, can last for more than a decade in a worst-case scenario. Keep in mind that taxation is a critical aspect of your investment journey, and capital gains and dividends are taxed differently in each country. You need to adjust the information I provide to your specific context. This is all for this video. Thank you very much for watching. If you got some value out of it, please like it and subscribe to the channel. It really helps a lot. Share your thoughts in the comments section and let me know which topics you would like me to explore in the future. And until the next one, remember, if nobody invests, so should you.